Just imagine two friends both earn rupees 30,000 per month, but one keeps his all money in a savings account and other invests through mutual fund. What will happen after 20 years? So after 20 years, one struggle financially and other creates significant wealth. Same country, same opportunity, but different financial decision. So now the question is, what exactly the mutual fund? Why do millions of Indians invest through mutual fund? Are they safe? And the most important question is, can mutual fund help ordinary people to create wealth? So in this video, I will explain all those questions. At the end of the video, you will get all information about mutual fund. So if you are beginning person in investment journey, please watch the video till the end to know about mutual fund. So to make this video easy to understand, I divide this video into 8 sections. So first section, you will learn about why saving money is not enough. In section number 2, you will learn about what is a mutual fund. In section number 3, you will learn about how mutual fund actually work. And in section number 4, you will know about type of mutual fund. In section number 5, SIP versus lump sum. And in section number 6, you will know about all myth related to mutual fund. And section number 7, how to choose right mutual fund for you. And in section number 8, mutual fund mistake to avoid. So now start with section number 1, why saving money is not enough. Problem number 1 is inflation. So what is inflation? Let's go to understand what is inflation with some basic example. For example, you have rupees 100 in 2010 and you can buy a chocolate. So a chocolate of rupees 100 in 2010. Could you buy the same thing today by rupees 100? The answer is no, because of inflation and the price increased. It's mean same things but higher price. Now problem number 2, savings account return. If you think you save all your money in bank account, it's another biggest mistake. Most of the people made this mistake because of traditional thinking process. Banks give you around 2 to 4% return and the inflation is 5 to 7%. So over the period of time, your money value goes decrease and you actually losing your purchasing power. So the biggest risk is not investing. The risk is losing your purchasing power. So it's all about why savings money is not enough. Now we comes in section number 2, which is what is mutual fund. In this section, we will learn about what is mutual fund. A mutual fund like a big basket of investment. Many people put money in that basket and a fund manager who use those money to buy stock, bonds and other assets. You own a small piece of basket, it's called unit. The value of your unit change every day based on the market. Simple example, suppose 100 people put their money in the basket and this basket is called a mutual fund. Section number 3, how mutual fund actually work. So there are some steps like step number 1, investor put their money. Step number 2, fund manager use those money. Step number 3, fund manager invest those money in stocks, bonds, government securities and many more. Step number 4 is you will be allotted an NAV price. Now you are thinking what is NAV, right? NAV called net asset value, just like a price of one unit of the mutual fund. Think it like a MRP of the product. It's tell you about how much one unit or one share of the fund costs today. So NAV change every day based on market. When the NAV goes up, your investment automatically goes up, and when the NAV price goes down, your investment value also goes down. Section number 4, type of mutual fund. There are multiple type of mutual fund in India, but you must need to know which type of mutual fund made for you. Not all type of mutual fund suitable for you. Those mutual fund are based on risk profile. How much risk you can take. We need to select mutual fund based on our risk capacity. So mutual fund likes equity mutual fund, debt mutual fund, hybrid mutual fund, index fund, sectoral or thematic funds, ELSS fund, solution oriented fund, money market fund. So now I explain all of those fund in details. So in first, equity mutual fund. So what is equity mutual fund? Equity mutual fund invest mainly in company share. In this fund, high risk but high potential of return based for long-term wealth creation. Number 2, debt fund. So what is debt fund? Debt funds invest in government bonds, corporate debts, fixed income securities. Those funds mainly safe than equity, but return are also lower than equity. Good for conservative investor who want stability. Number 3, debt fund. So debt fund is mixed both equity and debt. Here you can get a stable return as well as safety. So if your preference is safety plus stability, you can also invest in hybrid fund. So hybrid fund combine stock and bonds in one fund, balance between risk and safety, suitable for medium risk investor. For example, in hybrid fund they invest 60% in stock and 40% bonds. Number 4, index fund. It's also called a passive investment. So this fund simply copy stock market index like Nifty 50 or Sensex. So if you not know about what is Nifty 50 and what is Sensex, comment in below and I will explain both in details in my next video. So in index fund, no active fund manager manage your fund so that the fees are low, return match the index performance. For example, Nifty 50 index fund. Number 5, sectoral fund or thematic fund. So those funds invest only in a specific sector like IT, pharma, banking. Those funds also high risk because all money in goes into one area. Example like pharma fund invest only in healthcare company. Number 5, equity link saving scheme, ELSS. This fund with tax benefit under section 80C, locking period of 3 years, good for tax saving plus long term growth. Number 6, solution oriented fund. Those funds designed for specific goals like retirement or children education, have a lock-in period, for example retirement fund, etc. Number 4, money market fund. So what is money market fund? Money market fund invest in very short term debt instrument like T-bill, commercial paper, very safe but return are moderate, good for parking your money temporary. Section 5, SIP versus lump sum. So first you need to understand what is SIP and what is lump sum. So SIP called systematic investment plan. It's mean you invest your money systematically, like for example monthly, quarterly, annually, etc. And what is lump sum? Lump sum means you invest your money in one time. For example, you invest rupees 1 lakh at once. So those are the difference between lump sum and SIP. Now the question is, what should I choose and what will be best for me? Don't worry, the answer is very simple. If you have a large amount of money, you should lump sum investment, and if you have not any money to invest right now, you should choose SIP, that is systematic investment plan. That means you invest every month and you don't need any large amount of money at once. But 90% people choose SIP because they have not a large amount of money at once. Section number 6, all myths about mutual fund. So myth number 1 is mutual fund are gambling. The answer is no. Myth number 2, mutual fund guarantee return. The answer is no. By mutual fund you don't expect a guaranteed return. Myth number 3, you need a lot of money to invest. The answer is no. Start from small amount like SIP, which I already explained. Myth number 4, market crash means stop SIP. The answer is big no. It is the best time to buy your unit at discount price. Section number 7, how to choose a right mutual fund for me. First of all, ask yourself correctly. If you have any goal like wealth creation, buy a house or retirement, or your time horizon like 3 year, 4, 5 year, 10 years, etc. Risk capacity, high, low, medium. You should choose a right mutual fund for you, like your risk capacity, time horizon, and your goal. And the most important line is, don't choose a mutual fund because of someone said on YouTube. Choose a mutual fund based on your goal, your risk capacity, and your time horizon. And the last, section number 8, mutual fund mistake to avoid. This part is most important for every beginner. So mistake number 1, chasing past return. Mistake number 2, stopping SIP. Mistake number 3, investing without any goal. Mistake number 4, checking portfolio daily. Mistake number 5, expecting quick wealth. Remember one thing, mutual fund is not a gambling. So you can't create any wealth overnight. It's take time and you're patient. Just remember one thing, as much as you take risks, the return will be bigger. So your mutual fund return depend on your risk capacity. So at the end, mutual fund is not a shortcut key to become a rich. It's a tool. It's a very powerful tool to create wealth over the longer period of time. If you are a person whose time horizon in long term, who want to really create wealth, so invest in mutual fund wisely. It take your patience, your time, and over the period of time, you create a wealth. I see some people say about which mutual fund is best for me. This is not a right question. The right question is how much time you should stay in invested. If your time is long term, then the return will be beneficial for you. If you find this video is helpful for you, please subscribe to my channel and like this video.